Well, I'm sure anyone who has ever touched crypto knows that it's anything but risk-free.
I understand that you are focusing on DeFi, which is decentralized finance.
In DeFi and in crypto, it's what is called a trustless environment. You can't trust anyone and you shouldn't trust anyone. In 2020, the first year of DeFi coming to life, 10 to 15% of capital was lost to hacks. There is more demand for capital than there is supply of capital when it comes to this DeFi ecosystem, which means that if you're on the right side of it, the provider of capital, there is demand. And then the risk you take is on this security side, which continuously goes down. When you operate in an industry that's 24/7 and things move extremely quickly, you have to worry about everything.
That sounds scary, doesn't it?
Oh, absolutely.
Hello and welcome. It's Capital Horizons, the podcast where money meets politics. I'm Igor Yelnik. My guest today is Evgeny Gokhberg, founder of Re7 Capital. Hello, Evgeny. Very good to have you on the show.
Pleasure to be here. Thank you for having me.
All right. So you manage a digital assets fund, but as far as I understand, your fund is very different from what many other people do in the market. What are the main differences? I understand that you are focusing on DeFi, right, which is decentralized finance. So explain the difference. Explain what you do.
Yeah, absolutely. So having come from the traditional buy-side world, it took me a long time to understand the blockchain industry and how it comes together. At first, it felt like a Bitcoin Ponzi. Then it felt like an environment where you have a lot of promise for, Internet 2.0, but in practice, all you could have done was trade different coins, mine different coins, and not really do anything productive or useful. And about 7 years ago, that started to change when the first apps started to emerge on top of the blockchain technology. Now, the problem with the word crypto, with the word blockchain, it's very confusing because it absorbs many different things. When people talk about crypto, they talk about the asset class, they talk about the industry, and they talk about the underlying tech. Now, if we think about the underlying technology, which is, next generation cloud, which allows you to do same things as cloud, but in a slightly different way with new use cases that are being unlocked by this technology. Well, on top of that cloud, fintech apps started to emerge, where instead of building a traditional bank or a fintech app, you can just get a few software developers who write open source code that exists directly on the blockchain. Anyone can go check that code, verify that code, and interact with that code. Assess the risk if they're able to do so, and this is basically an open sourced ecosystem, an ecosystem of open innovation where it costs very, very little to build a business that could scale very rapidly. So, for example, I'm sure everyone has heard of Coinbase, one of the largest brokerage houses that's listed on a stock exchange, and there was a point in time where they had, let's say 5,000 people, or give or take a few thousand. And one of their peers that was built directly on the blockchain as a kind of this DeFi app called Uniswap was processing a very similar amount of volume, even though it was built by 10 engineers. So when I saw an ecosystem of these new next generation fintech apps emerge many years ago, I started kind of experimenting with it and playing with it, and it became very clear after a year of playing around that it's a kind of quite a rare moment in the history of financial innovation where new types of strategies emerge that could not have existed in the traditional financial market structure. It's not because they are rocket science or because they're genius. It's just that the market structure is very different. And specifically, the opportunity that I saw about 5 years ago was running a market neutral strategy where you basically deploy stable coins, which are, I'm sure everyone knows what they are by this point in time, but basically think of them as, IOUs issued by a specific entity. And in exchange for giving you the stable coin, they're taking that capital, they put it into short-term paper, usually hopefully treasuries, nothing too risky, and then they keep the yield, and you get this token, which makes it easier for you to transact. But effectively, it should be linked to dollar one-to-one, and then you can basically start providing liquidity into this DeFi ecosystem because you have a fintech universe of peer-to-peer trading applications, lending applications, and other type of traditional financial products and services, but you don't have the traditional market makers and bankers who can go and channel liquidity and inject liquidity into this ecosystem. So the role of a structured provider of liquidity is outsourced to an open market where anyone with a phone with a crypto wallet can do it. But if you're doing it professionally as a firm at scale, then obviously you have certain advantages. And that's basically what we specialize in. Deploying market-neutral stablecoin yield strategies across the DeFi ecosystem with the intention of earning yields by the virtue of being a provider of liquidity.
All right. So you are practically lending money. You are a sort of private credit fund. Are there any risks which are involved in this, and how are these risks different from the risks which private credit funds experience in the traditional finance world?
Well, I'm sure anyone who has ever touched crypto knows that it's anything but risk-free. So risks are obviously there. We're not. I'm glad that you brought up this kind of private credit comparison, because we often use it as a metaphor explaining what we do, whilst in reality we take very different types of risks. So the risk return profile of a DeFi yield strategy is indeed very similar to credit. Imagine that you have a portfolio of fixed income assets where you have no duration risk, you have no mark-to-market risk, and the only risk you have is and by the way, you can get out within hours, let's say, and the only risk is a risk of a default, which in this case, so that's the risk return profile. So even when we lend, it is over collateralized Lombard lending. So let's say you have one Bitcoin that is worth $100 today, and you deposit it into this codified digital escrow, a DeFi lending platform, and you want to borrow $70 against it. Now, we're not actually taking financial risk really, as long as we have confidence that your specific asset could be liquidated even in times of deep market stress, which obviously on the blue chips is perfectly fine as long as the code works. And if it's tail assets, then you take quite a bit of risk. And in all the history of financial volatility and market volatility in crypto, these DeFi applications, their code worked flawlessly because it's purely automated code. Now, what is the risk that we actually take? Like I mentioned in the beginning, everything in DeFi is open sourced. Everything is a piece of code that is openly available for anyone to see. Now, that comes with pros and cons. So why in the traditional world do we go to banks that are that we trust? Well, it's because we can't see their books in real time, so we have to trust the regulator, we have to trust their brand, and then they stand to lose more than to gain by trying to trick us, whilst a banking startup in a poorly regulated country is probably something we would trust much less. Now, in DeFi and in crypto, it's what is called a trustless environment, where you can't trust anyone and you shouldn't trust anyone because you're interacting with digital wallets, often un-KYC'd, and you just don't know. There's this joke that on the blockchain, no one knows you're a fridge, meaning that blockchain is a perfect internet of money for automated and non-human agents, as well as human agents. So the way how you trust is by verifying the actual code. So imagine that you have a bank and every single process, product, data point, statistic, and everything else is fully codified and is available for you to audit openly at any point in time, 24/7. So all this computer code is out there, and if you have the skills to read it, or you can hire a team who can read it, then you can build a certain level of confidence that that's a reliable digital counterparty for you to trust and to interact with. But these things also act as a honeypot, attracting malicious actors. So again, going back to the example of this over-collateralized lending, imagine that a market deposits, let's say, $1 billion of capital into this digital lending platform, and they want to borrow against it. So then we would come and we would lend against it. Well, this is basically a piece of code that is securing $1 billion of assets. So if there is someone who is capable of breaking that code and running away with the money, they have a very clear incentive of doing so. And that's basically the risk that exists. So to use a very
By the way, Evgeny, just 1 second. Would it be legal? Like
of
if you,
course not. I mean, it's robbery, right? It's
ah,
theft. But
okay.
the metaphor that I was going to bring up is, imagine you're literally in the wild, wild west, and you're going to a bank and you're assessing its security, right? Do they have security guards? Do they have a vault? Because it's wild, wild west and banks are being robbed here and there. So that's the risk return that exists. You're basically being paid double-digit yields very consistently in exchange for taking the inconvenience and the risk of operating with these digital products. So when I first was playing with it, personally, I got very excited to explore this further, because it felt that if someone could build a risk framework around this and measure that risk and quantify that risk, then maybe there's an opportunity. Because my background is traditional, equities, long, short, and that sort of thing. So if someone would come to me and say, well, please put money with us, but maybe it all gets hacked, then to me it feels like a very scary and a binary thing that I can't quantify, and therefore it's much easier to say no. So as I was thinking through that, I realized that this is probably how lending sounds to a non-financial professional, where the risk return was horrible, because you either make whatever 5% a year or you lose everything. But in reality, it's not as binary, right? You have probabilistic distribution, you have expected recovery ratios, and an end. And it's the same with these hacks. So these hacks, which are absolutely illegal, and there's been a lot of people who went to jail for doing that. But when there's a bounty pot, someone will try to get it. That's just an adversarial open market environment that will always continue to exist. So in 2020, which was kind of the first year of DeFi coming to life, probably 10 to 15% of capital was lost to hacks. So think of it as a 10-15% default rate across your fixed income portfolio, right? You go and
That sounds scary, doesn't it?
oh, absolutely. But in that year, your yields were 40%.
Okay.
So
And now?
and fast forward to today. So we've now been operating for about 5 years with 5 years of track. Currently, these default rates are about 3%. So about 3% of capital in DeFi is lost to hacks, and usually it's a bit less, but let's just be a bit more conservative. And the yields are, let's say, 15 to 20%. So what has attracted me to this specific opportunity and kind of gave me the confidence to build a firm around this has been basically two things. One, when you're effectively, like we're a fund, right? We're not a bank, but we are channeling liquidity into an ecosystem. So our capital is a commodity. And all I need to do is understand whether I'm on the right side of the supply-demand imbalance. And there have been thousands and thousands of platforms that have been launched. They all need liquidity, all they need capital, but there aren't too many people like us who are doing this, because for a variety of different reasons. It's not easy to do this. It's not easy to raise. It's not easy to scale. It's not easy to survive, and. So this supply
I
demand.
don't know, Evgeny, when you were discussing this, it didn't seem like it was very difficult, because you have open source code. Any person with some coding experience can read other people's code. You can evaluate this code, and you deploy capital into the system. Off you go. You earn your 20%, no?
I wish it was as easy as that. So conceptually, that's exactly what it's like. In reality, imagine we'll go to a new planet, and on that planet there is 10,000 companies, and all of them have bonds, and you need to study their materials in a language that you haven't studied before, because it is a new language, because it's all written in a specialized computer code. So it takes time to learn that language. Once you study it all, you need to develop a framework that allows you to assess that risk. Then you need to track all of that data. So we've, over the years, built something that looks a little bit like a Bloomberg terminal, in order for us to track all the information about all the yields, all the risks, alerts, and so on and so forth, because there is no Bloomberg that we can use for that. So anyone can go. It is very easy user experience, where if you personally have a crypto wallet, in a second, metaphorically speaking, you can get plugged into the ecosystem and start clicking buttons. But to do it at scale without, while generating, risk-adjusted returns which are attractive, and do it consistently with risk management and tracking end to end, it's a very specialized skill, because there is no transferable knowledge that where someone can quit their respectable job in traditional finance and next day start running a portfolio. It's a little bit isolated in terms of the nuances of how it all comes together. So the environment where we exist is basically there is more demand for capital than there is supply of capital when it comes to this DeFi ecosystem, which means that if you're on the right side of it, the provider of capital, then there is demand, especially if you're a go-to player in the space. And then the risk you take is on this security side, which continuously goes down as a ratio, because the industry is becoming more developed. There are more tools to protect, prevent, and catch malicious behavior, and effectively we've built a risk framework system where we are taking the same approach to security risk review that a bank would on the mortgage desk. So we've developed a framework where every single platform we touch is analyzed across a variety of different parameters, and then we say it's AAA, BBB, CCC, and create a well-diversified portfolio where hopefully we should be okay in any scenario.
Okay, so now you said that the hack rate is about 3%, and the ecosystem has grown. So this means that the 3% of today may even be bigger than, what was it, 20% or 5 years ago. So still there is quite a significant risk of losing money. Where do you think it's going from here? Do you think that this risk is reflected by the current yields available on these platforms?
Well, the yields that we've consistently been seeing and getting are double-digit yields, 15 to 20%. And in our particular case, within one of the funds that we run, our longest standing fund, we have lost less than 1% to these events on an annualized basis. So 3% is kind of the average for the industry, but through various methods, you can bring that metric down. So then if you're delivering double-digit yields whilst losing less than 1% a year, historically at least, then potentially it's attractive, or maybe not. Everyone kind of takes their own view. In terms of where it's going, the worlds are colliding. So right now, if you are a customer of Coinbase, for example, and you want to borrow stable coins against your ETH or BTC, your order goes into DeFi. So the lender is not Coinbase itself, is not a centralized counterparty they have become a relationship with. It is channeled into DeFi through various DeFi applications that have integrated with Coinbase. And it may be people like ourselves who are in fact lending to you. So this world of centralized, we have all these abbreviations where, we have this, traditional finance, we have fintech, and then on the crypto side, we call it DeFi and CeFi. So Coinbase, centralized finance, and then DeFi is all these crazy little apps that are not so little anymore, with about a couple $100 billion of assets sitting in them. So DeFi and CeFi emerging. Stripe announced their own stablecoin platform. Robinhood is tokenizing stocks. So DeFi, TradFi, CeFi, they're all converging. JP Morgan announced they're going to be doing their own stablecoin on the Base blockchain. So there is this saying that, fintech, Revolut being an amazing example of that, has been a front-end revolution where it's still more or less the same traditional rails that have existed for a long, long time, but it's just a much better user experience on all levels. While DeFi is just rebuilding everything in the back end, whilst being extremely painful to use. So all these things are colliding, and at some point, you'll be paying, using Apple Pay, and in the back end is going to be a stable coin that's routed through some DeFi channels or what have you, and it lands where it needs to land.
Okay, but before we speak about tokenization, can we get back to DeFi funds like yours, for example? And who are the investors in such funds? Who, who puts money there?
We only work with professional accredited investors. We have a variety of investment strategies. Some of them are extremely high risk. Some of them are, by crypto standards, are low risk, such as, let's say, the market neutral strategy. And it's pretty broad range of people, because when you have a market neutral yielding strategy, which is liquid rather than demands a lockup, with a pretty consistent track, then it could be a fit for anyone from a family office to a large allocator who are looking to diversify away from fixed income. Because obviously, it's at least to the best of my knowledge, it's very hard to be getting 10% plus yields in the traditional world, whilst being fully market neutral with no liquidity lockups. And ideally, at some point, you want to diversify away from private credit, which has been the go-to destination for these types of things.
Okay, I can imagine a family office or a wealthy individual putting money into such a fund. It's slightly more difficult for me to imagine a traditionally managed pension fund doing this, because even if the investment analyst understands what you are doing, and even if he or she is able to explain this strategy, it will be very difficult for the investment committee or for the board to accept those risks, especially since the crowd hasn't started moving in that direction yet, and nobody wants to stand apart and take the individual risks, because these very quickly become personal risks of losing job.
You're absolutely right. I'm not aware of a single pension fund that is allocated to a strategy like this. So that's 100% the case. But there are pretty sophisticated endowments, especially in the US. There are some banks which are quite advanced with their digital asset departments and kind of prop desks, and they're willing to allocate some capital. There are fund of funds. There are traditional hedge funds who are always on the lookout for unorthodox and unusual source of risk return. And that's, it's also important to mention that we exist in a much smaller universe, right? So when I started playing with DeFi personally, there was globally about $50 million of capital sitting in these apps of people like myself can find everything out. Currently, a couple $100 billion, which is obviously nothing by traditional standards, and that's the size of the top market. It's quite rare for a DeFi fund to be running hundreds of millions or $1 billion of capital. So for myself and my peers, we don't need the pension funds to come in at this point in time, because once they do, and once they come with very large tickets, they'll probably crush the yields anyway.
Yep. So that was part of my question, was an implicit part of my question when I was asking you about the yields going forward. If this is so attractive, then the capital must flow eventually into the area and crash the yields.
So that was, when I started raising 5 years ago, that was the first thing I was asked.
Sorry, I'm 5 years late.
Well, the question is very, very valid. And our best year wasn't 2021. It was last year, for example. So there is a long answer and a short answer to this question. Now, the long answer is some strategies rely on exploiting market inefficiencies, arbitrage opportunities, or something else, right? Something that is finite in terms of its existence, because large capital comes in and they close the spread, or the market structure gets better and the opportunity disappears, or technology gets better, or what have you. What we do is structurally different. And that's why it always takes us quite a bit of time to explain, what we do and how we do, because even though, we we have a fund. In practice, it's a very different philosophy where my job is to make sure that when there are quality peer-to-peer lending and, let's say, trading and market making platforms or whatever, they have enough liquidity to do what they need to do, subject to obviously risk and my return targets and hurdles. So a better comparison would be to think of it as a bank that channels liquidity into an economy, even though, again, we're not a bank. But our opportunity set grows together with the size of DeFi opportunity. It's like, imagine an opportunity set that JP Morgan had 100 years ago versus what it is today. And they've just grown together with their economy, even though the market has become increasingly more efficient. So when I started playing in DeFi, like I said, it was, 50 million or so. By definition, you can't deploy too much capital. Now it's 200 billion, which means you can deploy a lot more. And the question is, how many more DeFi platforms will exist tomorrow, and how big will this market be? And so far, all the data we're seeing is that there are more platforms being launched, demanding more capital than pension funds. So and maybe a very easy way to summarize it is think of the pace of decision making. It takes, well, I don't even know how long it takes a pension fund to go into an asset class like this. I don't know, 5 years, who knows? But obviously they're going to take their time. And the cost of you launching your own DeFi platform is, a laptop and a month of your life. So this year alone, there's been, I think, about 1,500 new platforms that went live. They all need at least 100 million of liquidity, at least, on average. So the pace of innovation of an open system will always exceed the decision-making pace of very, entrenched and traditional and very large, serious institutions. So that's a long answer. The short answer is that myself and most of my peers, they have 30-day redemption notices. So the market is incentivized to not crush the yields too much, because in 30 days, you're going to lose all your capital. And then, investors basically don't have to take that risk, because if the yields get crushed, they just exit.
Yeah. Okay. In your experience of speaking with investors, what was the toughest question you faced?
Where to begin? I think, in my experience, there are things that are hard to sell, where you have a lot of difficult questions you have to answer, and there are things that are hard to buy. And they're hard to buy because you just don't understand what you're being explained, not because you don't care or because it takes a long time. So in our case, in order for someone to be interested in what we do, they need to, at a high level, understand crypto as an asset class and crypto as an industry and crypto as a technology. They need to understand DeFi. They need to understand how yield strategies in DeFi work, and they need to be comfortable working with us. So that's a lot of steps, that a lot of boxes that need to be ticked. And I can't really think of a single question that's hard to answer. I think the real challenge and complexity is it just takes a lot of time to go through all of this and to self-educate or be willing to be educated. The hardest question is just, when you give them 30 minutes to explain what you do, and then in 30 minutes you have to summarize all of these things, which is not very easy to do.
Okay. Now let's switch gears a little bit and move to tokenization and real-world assets, which are now becoming available on chain. And there is quite a lot of talk about tokenization now. But can you explain how it really works and what's the purpose of the whole exercise?
It's a good question. Tokenization means different things to different people. We can probably run through like 3 different examples. So example number 1 would be, I know BlackRock has a fund they want to tokenize to offer it to new types of investors. Or a private credit firm wants to tokenize a private credit fund to get more liquidity. Or you have a real estate company that wants to tokenize a building because for some reason they believe that building should be tradable intraday. And then lastly, you have someone like Robinhood who wants to make stocks tokenized, because then it's 24/7 trading, which means more fees and more speculation at an end. So tokenization is a very interesting beast because we already have tokenization in traditional finance. We have ISINs, we have AMCs, and these types of structures. So it exists already, but their downside is that they're all isolated, right? If your specific bank doesn't support a specific sub custodian, and then things just break. So everything exists in kind of isolated tunnels. One of the value propositions of something like a blockchain is that everything has a unified standard. So if you have a picture of a monkey or a stable coin or Bitcoin or tokenized gold, it's all fungible. You can all trade it with each other, which makes it for an open ecosystem where a global standard has emerged, and you can save a lot of back office costs when it comes to these things. So you can argue this is not necessarily like a 0-to-1 innovation. This is more of a, let's take what has been done already, but deploy it on this whole new technology because it just unlocks new use cases and makes things much cheaper and much faster. And I'm going to just give up two specific kind of case studies and examples to see where to kind of highlight where I can see some value. Now, let's say you are, there's a group of 3 very large traditional institutions who are comfortable trading with each other. But they need to go through the traditional settlement processes, middle, back office, and everything else, which is obviously extremely expensive. Now, if they can have a blockchain which they fully control in any manner that they see fit, and they're trading via that blockchain, and they've tokenized a representation of a traditional asset, they would be saving, and it's well-known statistics, they would be saving billions of dollars in back office costs. So it's not exciting, but saves a lot of money. Then another use case could be, tokenize shares and make them 24/7, which personally I'm very against, because having left traditional world and now working in an industry that's 24/7, I very much miss my weekends. But but that's clearly where the future is headed, right? Because you can easily argue that maybe you need to hedge your positions on the weekend on the back of some event, right? And the world is unstoppable when new technologies emerge. There's always going to be enough energy and desire to make it happen. So you're going to have these 24/7 stock trading, which will make life of equity market participants harder, but it's just inevitable. And what is new and interesting is tokenized art or tokenized real estate, right? So things which are illiquid, but you can package them up and make them liquid and fractionalize them and what have you.
But then what do you own? You own a part of a painting, or you own, even with financial instruments, when you tokenize shares, what do you own? You own a reference to the share, right?
This comes down to a specific legal framework. So yeah, because different people do differently. Let's say there is a building, and that there is an SPV that owns that building, and then that SPV has shares, and the shares of the SPV are tokenized. That's one way how you can tokenize, for example, a building. I believe in Japan, if I'm not mistaken, they've actually tokenized like a building. So you literally own a piece of a building. Now, what rights and governance rights and so on and so forth you have, that's TBD, and it's all very non-standardized. More often than not, obviously, you don't have any rights. And generally, I'm not necessarily sure that's a great use case or a great thing to be doing, because you're kind of unlocking liquidity where it doesn't exist, but maybe it shouldn't exist. Maybe a fractionalized piece of a painting should not be traded intraday. Maybe that's not what it's supposed to do. So I think with tokenization RWAs, they're growing immensely. Everyone is jumping on that because it's potentially a new distribution channel. It unlocks liquidity. It potentially saves a bunch of costs, and in an end, but in reality, it's unclear what the actual value is. At least to me, there are some use cases where it's very clear, but these tokenizing ships or things like that and opening them up to potentially unsophisticated investors, that's maybe not a good thing.
Why?
Well, we've had this, crypto is very extreme in its market moves and its and the swings. So a few years ago, we had this mania of NFTs, right? And these non-fungible tokens are effectively tokenized pictures, right? And this was done in different ways, where I create a, it's like, those of us who remember stickers in their childhood, and you collect these stickers or these collectible coins or what have you. Let's say I go and create a picture of a monkey, and I do 10,000 of them, and I call it a collection. And, I sell it, and they become tradable, and people start to gamble on that. So we've had, boom and bust of those things. We've had people tokenize art and paintings, and then an NFT of an art was sold for, I think 69 million was the highest one. So we have had that experimentation where we've tokenized these very unusual things and tried to inject them with meaning and utility. But what ultimately ended up happening is, a lot of people lost a lot of money because they were gambling on extremely illiquid assets, which had no substance. And that's what I see as a challenge with making difficult assets immediately tradable.
But when you think about companies, they're not immediately tradable. You can't buy or sell a company of the size of, let's say, Microsoft or Nvidia or General Motors or things like that. But you can buy and sell shares of those companies. And even though the company itself is illiquid, the share of this company may be super liquid. And this allows the market to determine a fair price.
Of course.
And eventually this leads to a reduction in the cost of capital. Now, a painting, for example, may be costing you, I don't know, $100 million. And there is only one owner of that painting, and it's very hard to, short the painting. But if we imagine a similar structure where this painting will be held in some custody and shares of this painting are tradable, then you can determine the price of this painting in a very efficient way.
So now I will have to, summon all of my memory from my corporate finance days, where in an efficient market, as far as I remember, the value of the stock is clearly defined, right? Because the company is supposed to have a bunch of cash flows, and as a stockholder, you have a claim over that in some shape or form. With assets that don't generate cash flow, it's the price is what someone else is willing to pay. And at least in what I've seen so far, how the more permissionless and open crypto world has behaved is the more opaque and confusing the price discovery process is, the more likely it is that a lot of people will lose a lot of money, to put it very simply. So
a lot of people lose a lot of money in the equity market.
Well, that's true as well. If you own a share of a painting, it's less clear to me. It feels the risk return is skewed to the downside, to put it simply. And what I mean by that is, you're not going to be getting any cash flows. You don't get the actual benefit because you can't, you have no rights over it. And historically, with these liquid assets, market can disappear from right from under you, and then you may be stuck with something you can't liquidate. So it's just a much higher threshold to get it right. And like I said, with these new types of technology, it's inevitable. Like, this will happen. This is happening already. But where I see more clear utility is on the more traditional side of things, where equities on 24/7, and then the Fidelities and the BlackRocks, they settle tokenize things on their side. These funky, I haven't yet seen a use case for these, let's say, funky tokenized assets where it made a lot of sense. Again, if let's say you're doing something with hard assets and you're just doing it to save some back office costs, then that makes total sense. But it's very nuanced.
Okay. Are there any legal or regulatory constraints which prevent tokenization on a large scale?
Well, yes and no. Obviously, there is a lot of nuance around how that works, but there are, well, to put it very simply, I mean, BlackRock have tokenized some of their products, and so have many others. So if it's good enough for BlackRock from a legal risk standpoint, then clearly it's okay. But it's to a certain extent it is uncharted territory, but it's much more charted now, so to speak. And with the, you know, the industry has been very much emboldened by the new U.S. administration. So for the next few years, we can make an assumption that large financial institutions will continue to launch a lot more tokenized assets. We're working with one of them to help them to get one of their upcoming RWA assets gain more utility in DeFi. So that trend is accelerating. So there are nuances, but they're all very manageable as we've seen.
Okay, and we're coming to the end of the conversation, and I would like to ask you two things. The first one is, what keeps you up at night?
Apart from a million market alerts and other things I'm getting.
Yes, that doesn't count.
It's a good question. When I was launching this firm, I was hoping that, I'm fulfilling my lifelong dream of, being a portfolio manager and, running a cool strategy. But when you're the founder of a company, you have to worry about everything, your people, and everything else that comes with that. So there's just a million things. When you operate in an industry that's 24/7 and things move extremely quickly, you have to worry about everything because, a default, unlike in the traditional world where, it takes forever, then it happens all of a sudden kind of thing. Here it truly happens immediately. You can wake up and the market is down 40%. And it's just a much more volatile industry, both from a market and operational standpoint. So it's easier to say what doesn't keep me up at night.
Okay. That's a good answer. My last one. Somebody asked me this at some point, and you know that I manage a systematic macro fund. And somebody asked me, what advice would you give to someone who is willing to start a systematic macro fund now? And my answer was, don't do it. May I address a similar question to you? What advice would you give to someone entering the crypto digital asset management space today?
That's a great question. Well, my first instinct is to give exactly the same answer, probably. I would probably, like on a serious note, I would probably suggest that person would need to be extremely precise with the kind of strategy that they would launch, because like running, let's say, a long-only strategy from personal experience is extremely hard, and harder than you think, because you're like, well, it's hard, but it's okay. It's harder than you think. If you're doing systematic in crypto, we don't do that, but I am in awe of some of the people who do that. They're extremely professional and sophisticated. So competing with them, I think, is very, very hard. The DeFi world where we operate comes with a lot of stress. And yeah, if I was just coming into the DeFi world today, I'm not sure I would do it exactly the same way, because it feels that the mode and it just feels harder than it was. So like a solo founder is just less likely to win. So it's hard for me to say. A lot of very successful people in crypto have benefit on the systematic side. They've benefited from structural market inefficiencies, whilst now things are a little bit different. So that's probably the only advice I would give, is just to be extremely selective in terms of what strategies you actually pursue.
Okay, thank you very much. This has been a very interesting conversation.
Thank you. Thank you very much for having me.